Your Royal Highness and ladies and gentlemen, it's my real honor to join this very important event. And year 2019, I had a tremendous honor to meet Your Royal Highness 3 times. The last time at the British Embassy in Tokyo during his royal visit. And it was during the Rugby World Cup, but I think it's totally accidental that hit that particular timing. This is my 3rd participation at the A4S annual event. And I just wanted to share with you that I am the living example of the finance leader inspired by A4S. So 3-4 years ago, first time I came to join this event, I had a very little passion to promote the sustainability in our portfolio. And I was really busy to make money. And then I just came to realize that there's something wrong with it. So I started thinking more holistically. And if Your Royal Highness can drive this change, I have a little bit better knowledge about the finance, so I should be able to contribute. That's how I just determined to just make differences in this industry. So several things we have done during this year, which I want to share with you. First, we started this year by reporting one of the biggest quarterly loss of our history, which was $150 billion quarterly loss we made. So we lost as much as one of the major US public pension funds over 3 months. And at that time, everybody could be very, very, become shrink and try to become defensive. But we decided to actually just use it to make a differences. So we revised our investment principle to make very explicit reference to ESG integration and also ESG integration in all asset classes we manage. So we started ESG integration and stewardship activities in equity portfolio. But now our investment principle, which is a kind of our constitution, says very clearly we have to integrate ESG issues in every asset classes, equity, fixed income, and a private asset as well. Which makes a GPIF a bit different from the other sizable asset owner is we are regulated to outsource 100% of our equity portfolio and the foreign fixed income portfolio to money managers. Very unusual because the other asset owners of our size, there's nobody has our size, but the other similar to our size, they usually take investment in-house. But we are regulated to outsource, which made us the biggest institutional clients of asset management industry. So I decided, rather than lobbying Japanese government to let us manage money in-house, we decided to use that leverage to affect the way this industry works. So we now make a very clear statement. Every single asset manager who manages our money, regardless of asset classes, are required to integrate ESG. And ESG integration is the word people use quite casually. But this year, we made a quite clear definition of what we mean by ESG integration, which is systemic inclusion of ESG factors in investment analysis, as well as investment decision making. Because we heard a lot from asset managers, yes, we analyze ESG, but when they make the actual portfolio investment decision, they forget about it. Right? So we made it very clear. They have to be integrated in analysis and decision making. We also demand our asset managers to engage with their portfolio companies on material ESG issues of their choosing. Climate is everybody's topic. So we expect all our asset managers to engage with their portfolio companies on those climate issues. And this year, we started holding them accountable. So every asset manager who says climate is a major material ESG factors for them to engage with the company, we track them, how they vote. So there are some discrepancy between what they say and how they vote. We're not going to keep, we are going to keep make them accountable for their promise. So I'm not going to name it, but some manager lost quite big in a mandate because there's a huge discrepancy between what they say and how they vote. And we also made a bit more precise, systemic integration of the ESG into our own portfolio management. For the passive managers, now we have been discussing with all the passive managers that whether they can integrate ESG into their passive portfolio management. Half of passive managers told me they can do it. The other says that's not our job. So we are now comparing who will give us much better value. And we also told our passive manager, I'm happy we hire you to manage portfolio passively, but it doesn't mean you can be a passive owner. So all our passive managers now evaluated how active owner they are. So our managers, some of them, if we can agree with their KPI, we pay extra layer of fee to our passive manager for those services. So actually 2 passive managers of our portfolio now receive $1 million extra fee for their stewardship and active ownership role. For the active managers, there's a huge debate whether we should ask the active managers to integrate ESG for their portfolio management because they are remunerated for their alpha delivery. And this year, after a long discussion internally, we concluded we should demand the active managers to integrate ESG as well. So now we evaluate their ESG integration as a part of the investment process in their overall scoring. And then let me put that this way. So if the 2 active managers came to me for a GPIF mandate, and both of them said, we deliver you 2% extra return with this particular risk budget, we will definitely pick the one who says we control negative externality of our portfolio company better. So we are not only evaluating and comparing alpha and a risk, but also we check how well they control negative externality of their portfolio companies. Discussing with the passive manager, we came to realize the importance of index. So there are some index providers in the room, but we are now detaching the index provider contract from our asset manager contract so that we can engage directly with our index providers. Because at the end of the day, index providers who really dictate what we ended up owning. Because not only passive, but also active manager, they have a manager benchmark, right? So to certain extent, even the active manager, they have to track the index. So we came to realize the importance of their significance of their role. So now we directly engage with the index providers, how they build the index and also their own governance. And at the same time, we started a shift of our manager benchmark from the conventional market cap weight index to ESG weighted index. So we now selected 5 ESG themed indices, including S&P Carbon Efficient Index. And 10% of our equity portfolio now tracked those ESG indices. And we are in the middle of RFP for Global Universal ESG Index and a Global Gender Diversity Index. The third one is a Global Green Bond Index. So we are now taking more and more efforts on selecting index and shifting the money towards the ESG-based index. And we are in the middle of discussion of revision of our policy asset mix. And as you know, policy asset mix also have their own benchmark at the very highest level. And we are debating whether we can replace the other, like MSCI ACWI with the MSCI ESG Universal. All those kind of shifting the policy level benchmark to ESG weighted. That will make the quite categorical impact on how we manage it, how our asset manager manages our portfolio. So when it comes to fixed income, we started ESG activities with the equity investment, and the fixed income ESG investment is very new. But last year, we decided to make more effort to promote the green bond, the social bond, or sustainability bond as a major investment product. As you know, it's becoming popular, but it accounts for less than 1% of global fixed income market. So it's a marginal product. We determined to make it mainstream. How to do that? The challenge was, a lot of the active managers approach us and say they can manage the green bond, But the problem is, active manager, they have to sell when the market price picked up. And the benefit of green bond or social bond can benefit the investor if you hold that long enough. So we decided to incentivize our passive managers to buy green bond or social bonds. So we allowed our passive bond managers to go off benchmark to the AAA rated MDBs if they issue green bond or social bond. And the funny thing is, 2 years ago when I came up with this idea, I discussed with all our existing bond managers of how they think about the green bond. All of them said it's not attractive enough. But if you like me to do it, we'll do it. But it's not very attractive because it's less liquidity, etc. But as soon as we told them, we are going to let you go for all benchmark, they found a way to make the deliver alpha, because if they switch the AAA rated MDB green bond with the US Treasury bond, they immediately deliver alpha. So tick the box. And then they started complaining there's not enough green bond in the market. Right. I said, okay, you told me it's not very attractive 2 years ago, but I still remember your face. But so we started agreeing with the other MDBs. The last March, our first partnership with the World Bank Group launched. Through that partnership, our asset manager can directly buy green bond issuance through the private placement. And it's very successful. Now, after 12 months, actually 9 months, we agreed the same partnership with 7 MDBs, including African Development Bank, Islamic Development Bank, EIB, and you name them. And our portfolio, our holding of the green bond was $30 million last March. Now we have $3 billion. So if you change the rule of the game, you can build the portfolio very quickly. And that's one example how you can affect the way the people work. And to make these kind of things happen at the end of the day, which is very important, is how to make the information flow and how to make the investor, make informed decision. 18 months ago, I met with Mark Carney here, actually, and he asked me whether I'm interested in TCFD, and my reaction was, what is TCFD? And then I came to realize that the TCFD is one of very high-level framework, and it's actually may be able to turn the mindset of the Japanese corporates. So I promised to Mark Carney that we'll make Japan a champion of TCFD recommendation. After 12 months, we have 216 TCFD supporters, the largest in the world. And last September, we hosted the TCFD Summit, which we invited all the global leaders in a TCFD recommendation. And he asked me, what's the key of success? And my secret of success is twofold. One, usually TCFD, because it's a legacy of like a financial stability board, it usually goes under financial regulator. I actually invited the economic and industrial ministry to get on that, because if it's dealt with the financial regulator, it made a portfolio company very defensive. So we invited the Ministry of Economy and Industry to be a leader of that initiative. And the second secret is, although the initial concept of TCFD is if the institutional investor or the bank demand their borrower or the portfolio company to report the climate risk, they will obey. But I'm a bit skeptical about that effect. But instead, we actually went to the OEMs to sign up to TCFD first. So as soon as Toyota signed up to it, they have 2,000 global suppliers. They have to report in accordance with TCFD to remain as the other supplier. Changing a cost of the shareholder, changing cost of the bank is no longer very expensive, to be honest. But the changing cost of the OEM is almost detrimentally expensive. So that we invited all the OEM to become the TCFD supporter first, and after that is an avalanche effect. We don't even need to push. So, And coming back to Your Royal Highness, the biggest contribution to this industry is the integrated reporting. I remember our first conversation, the Royal Highness, you said that we have very little hope for Japan. Now we have 600 Japanese corporates report integrated reporting. So now there's a competition among Japanese corporations, how they can improve the ESG reporting. And we try to support it by, for ESG integrated reporting, every year GPIF give an award to the best integrated reporting. And now there's a competition among Japanese listed companies to get that award. And for the TCFD, we don't give them an award, but we actually did a different approach, which is GPIF become a signatory, and we did our first reporting of a TCFD compliant disclosure. Unfortunately, our portfolio diagnosed to be aligned with a 3.5-degree world. And I say, our portfolio is one of the one of the biggest and the most globally diverse portfolio. If our portfolio diagnosed to set for 3.5-degree world, that's where the world is heading. So we need to change it. Okay, so, and we remained as a sort of litmus test. So the world, the GPIF's portfolio becomes 2-degree or 1.5-degree aligned when the worlds become that way. So as we did it, this year, every asset manager working for us, we require them to do a TCFD reporting. When I asked this to the asset manager for the first time, their response was quite negative, saying first of all, we are merely agent. I hate it, but they said we are merely agent. And the second is, we cannot analyze the client's portfolio. And I said, you told us the climate risk is a major and the most material risk of the portfolio, and then I cannot hire you if you cannot analyze and diagnose the portfolio I ask you to manage in terms of that risk. So I think now they have to do it. I don't know how they do it, but they have to do it. This is the luxury of being a customer. We ask them to do something, and I don't know how they do it. But so the other thing is, so we are basically trying to create the other atmosphere that the corporate have an incentive to disclose more ESG information. And also, we are making an effort to make the cost of that reporting cheaper. So the one way to do it is, I mentioned about the ESG indices. Every index we choose, we demand index provider disclose ESG scoring methodology. So the company knows exactly how they can improve their ESG score by any ESG index providers. So finally, but not the least, last week we dropped a big bomb in the industry by announcing GPIF going to suspend our stock lending program. It was a hard decision. I discussed this internally for a year because we make $300 million. It's easy money. But I found it's totally inconsistent because we keep asking our portfolio company and our asset managers to manage their business with long-term perspective and tackle all these long-term issues like a climate change, while we are making a penny, it's not a penny, $300 million, by lending a stock to the short seller and putting a short-term pressure on the corporate executive. We thought it's totally inconsistent. So we decided to quit it. But we got a huge pushback and very mixed responses. Elon Musk tweeted, "Bravo!" And some people say, the short selling adding a value, adding a liquidity to the capital market, which I don't deny. And some of the board members criticized my decision, saying that the GPIF need the liquidity when we sell it. And my argument is, we need the buyer when we seek liquidity. We don't need the seller when we seek liquidity. So it doesn't help us anyway. But that's actually the one thing that we are trying to question the industry. We are doing a lot of things. It's totally inconsistent with what we are saying. So we are saying we are going to tackle this climate issue. We have to revisit all our practices. If there's anything inconsistent with what we are asking, we need to change it. So, ladies and gentlemen, and Your Royal Highness, the journey in front of us is really, really difficult and challenging. But all Japanese people this year found out nothing is impossible. Even a Japanese rugby football team can beat the Scottish and the Irish football team. Thank you very much.